Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all.
Real estate experiment. What is happening, y'all? Today we got Eric Braun in the building with us in the lab. Thanks for making it happen, man. Like I said, I was saying this offline. We keep things just real transparent, man. You come into the lab, you step in, you're a practitioner. I love what you're doing. I got a chance to check it out. And yes, through the gram. So you guys make sure you check them out. We'll definitely have that in the show notes. But I just find it fascinating that you're a lender and you are doing this actively as a practitioner. And I came across you on social media, and that's one of the conversations I want to talk about too, is how we're using it as a tool to really just touch people and help people. So, but why don't you just tell us who Eric is and how you got started and who you are now? And it's good to see a refreshing face in the building, man. So tell the people who you are, man.
Thank you. I appreciate it, man. First off, thank you for having me.
Of course.
You know, it's always good to connect with like-minded individuals and see what kind of collaboration we could do together. Any way I can add value to you, man, that's what I'm all about. So, yeah, I mean, my story, there's a lot of different components to it. Just to keep it short, I actually got started in the industry about 4 years ago. I started as a telemarketer, so cold calling for the first 2 years of my business. And it was a rough experience. I wasn't licensed. I wasn't really 100% sold on the industry and the opportunity that I had in front of me. But after some serious soul searching and I guess some pain and uncomfort feelings, I said, you know what? Let me take a real crack at this. And that was 2 years ago. I got licensed, started building my business, and now it's really cool, and I always say blessed to have the life that I have and have the business that I have and have the relationships that I have. And 2020 is looking very, very good. Thank God.
That's awesome, man. You know what's crazy about that, Eric? I read this, and I don't know. You got to tell me. I got to hear it from the horse's mouth. Apparently, lenders it's one of the most fulfilling professions out there. Like it was actually statistically done that this is one of the most, I guess, fulfilling professions. You want to talk about that? I mean, what do you tell the people what you do? Because, they hear lender, they hear mortgage broker, they hear, maybe you want to tell the people who you really are and then what it is that you're doing for most folks out here.
Yeah, I mean, my comment on that would be I don't know many loan officers who are fulfilled doing what they do.
Really?
However, I definitely am. And this business has definitely changed my life forever. And now what do I do on a daily basis? I help people finance homes. So very, very simply put, if I'm looking to buy a house, most of the time I don't have, let's say the house is 500 grand. Most of the time I don't have 500 grand to buy a house with. So that's where a bank comes in, and that's what I help kind of navigate. I navigate people through that process and make sure that they're making the right decision and make sure their qualification meets the qualifications needed to get a loan ahead of time, so there aren't any explosions during the process.
Yeah.
But yeah, so that's kind of what I do on a daily basis. And simply put, obviously there's a lot more to it than that, especially on the building the business side of things. Maybe at the semi-macro level where I'm kind of meeting with referral partners and the behind the scenes stuff, if you will. But generally put, I help people finance houses.
Which we'll get into, because you're not going to sneak into the lab without us really understanding. Because what I always say, Eric, is I love having practitioners or subject matter experts, as I would call you, come into the lab, because that's the only way we can understand how to do business with you, right? Mm-hmm. And obviously, our community is made up of a lot of different folks who are majorly entrepreneurs in real estate, right? So I have a lot of multifamily apartment guys who come in here, which is a complete different ball game. But I really want to touch up on the person who, there's a lot of entrepreneurs who are literally, making a lot of money and or maybe not even thinking about investments or getting into a property for themselves. And it sounds like, correct me if I'm wrong, I think it was like 90% of the people that you help are first-time home buyers. Is that correct?
Yes. Yeah.
Okay, excellent. Do you want to talk about you mentioned this in one of your posts too, which I follow you closely. I got to do my homework, man. So, you mentioned there's a few things that tend to come up. Do you want to talk about some of the misconceptions that people have? Because I think that's really where I want to hone in on. This is a knowledge place to learn. So, what are some things that continue to come up that you're like, man, isn't it so obvious for me and my lens? But what do you see?
Yeah, so a few common misconceptions that you even may have heard that are misconceptions are, I need perfect credit to buy a house. I need an 800 credit score. That's completely incorrect. The requirements are based on government guidelines, and it's not an exact science, so there is some margin for this. But for the most part, FHA requires a minimum of 580 on the credit score, and conventional or Fannie Mae and Freddie Mac requires 620 score minimum. And there's a lot more to it than that, but just to give you perspective, you don't need an 800 score. That's one common misconception. Number two, I'd say, is I need 20% down to buy a house, right? That is also far from the truth, right? Conventional loans, you can do as little as 3% down for first-time home buyers. Sometimes it's 5%. And then for FHA loans, you could do 3.5% down. And when I say FHA, conventional, those are terms that I throw around very, very often. But for a first-time home buyer, it's like, what's FHA and what's conventional? Those are two main types of loans that are commonly used for first-time home buyers. Now, that's down payment. So we went over credit score, down payment, and a lot of people think I need to make a lot of money to buy a house, which is also not the case. They generally want to see that you make, and this is a general rule of thumb, just keep it super simple. It's based on what's called the debt to income ratio, which I can break down, but
that's right.
They generally want to see that you make double what your mortgage payment is going to be, including all of your other debt. So for instance, my mortgage payment is $2,500, all of my other debt, the minimum payments on those are $1,000. So in total, that's $3,500 in total debt. I need to make double that. What is that? $7,000 a month, right? So that's generally speaking, very, very simple for conversation, how debt to income ratios work. So you don't need to make, $200,000 a year to buy a house either. So those are just a few common misconceptions, and obviously there's a few more. Oh yeah, I would also touch on, all right, yes, I can buy a house with minimum down, but my monthly payment is going to be so much higher, and I should save for my 20% down payment. There's truth to that, and there's not truth to that, right? So every $20,000 that you put down is going to be about $100 difference in your monthly payment. So sometimes it makes sense if it takes me 2 years to save $40,000, right? And that's at a saving at a very aggressive rate. If it takes me 2 years to save $40,000, I'm only going to save $200 a month.
It's opportunity cost.
Exactly. And now what if I'm spending rent for those 2 years? So if I'm spending rent and I'm throwing down the drain, let's say $2,000 to save $200, you know what I'm saying? So there's pros and cons that you have to run. And it's important. The biggest advice that I can give any first-time home buyer, could also be another common misconception, is you need to speak to a mortgage professional. You need to figure out the financial stuff before you look at houses.
That's right.
Everything else does not matter until you figure out the financial information. You need to know financially what it looks like to buy a house before you go look at them, right?
Yeah.
And that's kind of what I try and focus on for first-time home buyers, as you might have seen in that post that you're referencing.
Yeah, no, I think those are great points that you brought up, Eric, because I think we talk about this all the time on even at a larger scale. It's your opportunity cost, right? I mean, I just had AJ Ramler, shout out to AJ Ramler, was just talking about know your numbers, and he's doing actually residential, and he got into his home house hack, as you might know if you're part of the bigger pockets, where you live in one and rent out the other, and his whole thing, he's talking about how I can actually put, I can be more liquid by being residential, by understanding the numbers and being able to refinance, et cetera, down the road, which I'd love to talk with you about because that's a big topic. But I think initially, if you're listening to this and you're a newbie, I think you hit the nail on the head when you're talking about the it's kind of like being a penny wise and a dollar foolish.
Yes.
Like, when are you going to save $200 and continue to throw money out? I think that's my biggest key takeaway, and I just really want to bring that home because I haven't heard that, and that's actually very refreshing to hear that from you, Eric. So good stuff. So interesting. So two things I want to talk about, because we actually had a guy who came in. He's a kind of a credit guy, and I'm curious as to hear what is it that you're telling buyers that come in and they're saying, hey, first of all, here's my budget, and you're like, well, hold on, it doesn't work like that. Let's get you pre-approved. So hold your horses. But how do you help, or where do you guide folks who may be not ready? I'm curious as to, as a professional, do you work with credit repair? Would you even advise people to do that? Or do you think that business, like what is your whole take on that business model? Because I know there's a lot of stuff going on out there, and I like having experts come in and kind of like give us the flag of what's good, what's the noise. What is your thought process on this stuff?
On credit repair, you're saying?
Yeah.
So a lot of the times I look at credit every day. I don't claim to be a credit expert. I'm sure there's people who know more about credit than I do. However, I like to think I know a decent amount. If I'm helping 10 families a month, that's just 10 families that I'm helping. That means I had to look at 30 credit reports or 40 or 50 credit reports that month to make that happen. So I like to think I know what I'm talking about when it comes to credit. There's definitely creative things that you can do in credit. There are reputable credit repair companies that know what they're doing and actually accomplish the things that they say they're gonna accomplish. What I like to do with my customers, and this isn't for everybody, but the first thing that I do when I look at a credit report is see if there's any ways we can boost it, right? And when I say boost it, most of the time what that means is paying off some debt. So where's my money best spent? Is it on the extra 10 grand to put down or 5 grand to put down? Or can I take $3,000, $4,000, $5,000 of that money, apply it towards my credit, my debt to pay off some balances so that my scores then are in the 700s and I can do a conventional loan versus an FHA loan and save money monthly on the mortgage insurance. And I can get into how that actually all works, but that's just one example of how sometimes after looking at a credit report, I say to myself, if we get this to an X on their middle score, their options will open up, and maybe that's a better option for them. So I don't necessarily always use credit repair. Sometimes it's as easy as paying down a balance to get another 50 points on your score.
So I'm so glad you said that, and I want to let you finish. I don't want to cut you off. Finish that.
Yeah,
So I'm so glad you brought that up, because earlier you opened up the episode and you started, talking about FHA and conventional, and you mentioned 580 versus 620, and you also mentioned, so this is interesting. Let's bring this together, because you talked about how you don't want to necessarily save $200 when you're waiting 2 years, but now we're also talking about, okay, again, opportunity cost. Where is your money best well spent? Yes. So you're saying, Eric, if I understand correctly, that you're better off sometimes taking that money, paying off whatever that big, lowering your debt to income ratio, right? Is it lowering or increasing? Lowering your debt to income ratio, so that you can then jump into a score that on the long term, on a 15 or 30-year loan, is going to save you tons of money. Is that what you're saying? Right. I don't want to put words in your mouth.
Correct.
Okay, that's really interesting, because we don't talk about that enough.
Yeah. For instance, I have a client today. I'm actually, his brother-in-law is scheduled to close, and I was able to help him. Okay. And his brother-in-law refers him over and says, listen, my brother-in-law is doing a mortgage. I told him how you work, and I was working with the lender that he's working with currently, and I showed him my paperwork, and I was getting a lot better deal than he was, and he wants to speak with you. So this individual has a 619 credit score. Okay. Minimum credit score on a conventional loan is 620. All right. So what is his current lender doing? Going FHA, which there's nothing wrong with that, right?
But I see where you're going with this. Yeah.
Right. Now, what also is very important about this scenario is this individual has $200,000 to put down, right? So what I said is, okay, you have $200,000 to put down. Let's pay off a $2,500 credit card. Get your score to a 650. Now you can get a conventional loan and not have mortgage insurance. So this, just by paying off $2,500 in debt, he no longer has to go FHA. He can go conventional. Since he's putting more than 20% down on a conventional loan, he doesn't have to pay mortgage insurance. With the FHA loan, he was paying about $300 in mortgage insurance. So by paying $2,500 on his credit card, he was able to get the same rate, same closing, actually lower closing costs, but save $300 a month.
Can you imagine the ROI on that? Like on that 2,500? Yeah. Like if we do the math, like I'd like to actually know. Well, we'd have to do
you would recoup the cost in a few months, you know?
Yeah.
And it's not like he doesn't plan on paying that credit card anyway. That's his debt. He's going to end up paying it, whether he likes it or not, or, you know, he's going to really mess up his credit score. But that's just one example of kind of knowing your guidelines, knowing how to plan and work the guidelines in your favor. And the lender that he was with, that's an example of just taking the easy route. All right, this guy's got a 619 score. You know, the ratios are maybe a little too high for conventional. Let me just stick him into an FHA loan. And what that lender said is, hey, in 6 months, when your credit score gets better, you can refinance. And what that tells me is that lender's trying to get paid twice.
Wow. So,
I mean, for me, this is a long game, right? I don't want to do 2 loans. This is already a referral because of how I work. So I'm getting a referral, you know, to get another referral and to hopefully get another referral. You know, yeah. It's not about a transaction for me, and it's really just doing the right thing. But that's the difference in a point or a few points in your credit score, and kind of getting creative and using your money correctly to open up your options.
That's fascinating. I'm really glad those are your core values, and it shows in your work that you're getting referral business because of that. And like I said, don't go anywhere else, y'all. Yeah, Eric Braun in the building. He's right here, man. The man is right here. I don't need to go anywhere else. So that's fascinating.
I'm Instagram. It's not your average lender.
I know. I like that. I thought that was fascinating. That's such great branding, which we're going to talk about in a second. I'm not going to let you get away without talking about branding, because I think you're doing a phenomenal job, in addition to being a practitioner first, which I love.
Thank you.
So Eric, tell me a little bit about, you mentioned refinance, and first of all, kudos to saving that gentleman lots of money down the road, him and his family. That's huge. Can you talk about refinance? Is that something that you do a lot for folks, or you've seen? Okay, great.
Yeah.
So would you advise someone, you know, when is a good time? Let's talk about some of the misconceptions about refinancing, because we hear it a lot, especially in our world here on the investing side. Or people, hey, I want to get my money out. They read about it. I'm like, oh yeah. Can you talk about maybe even yourself? Because maybe, does it change from lender to lender? Let's start with that. And what is it? Explain to the people what refinancing is, and, you know, what makes an individual eligible to refinance.
Yeah. So a refinance is Very, very simple. It's you have a current mortgage that you have on your house. What a refinance is you're getting a new loan to pay off that old loan, and that new loan has better terms. Better terms doesn't necessarily mean lower payment all the time. It could mean you wanted cash out, so pulling cash out. It could mean lowering your term of the loan, so from, let's say, 30 to a 15. It could mean removing mortgage insurance. It could mean consolidating debt. There has to be nowadays, after the whole subprime market fell out and the government came and regulated the mortgage industry, there has to be what's called the net tangible benefit. So you can't get a refinance approved unless an underwriter says there is a benefit to this loan, right? A benefit, again, doesn't necessarily mean lower payment, because that isn't always the goal. It could be to shorten the term of the loan, which may increase your payment. But anyway, that's very, very simply put what a refinance is. It's you're taking an old loan, you're taking a new loan and paying off the old loan, and with some sort of change or benefit to the numbers.
So that's interesting. Net tangible benefit. So does that mean, Eric, if I go out there to any lender, I really want to bring this home, and I understand myself because it's a valid question I have for myself. Does that mean that I'm protected then, and that no lender can really refinance me something that doesn't make sense on paper? Is that what you're saying?
It should be.
Okay.
Yeah, should be
ideally. Okay.
Yeah. So, there should be a net tangible benefit. Are there some refinances that have better benefits than others, right? Or are on edge? Absolutely. What you then have to look at is, what is your plan with the property?
That's right.
Do I want to refinance a house that I plan on selling next year? No, right? But on paper, it would have a net tangible benefit if I don't calculate the fact that I'm selling it next year.
Why can you take a step back and tell us why that might be a bad idea? I'm sensing maybe equity, but I'm not too sure here. Can you enlighten us?
So when you do a refinance, there are closing costs associated with it.
Okay, so you'd be paying those twice essentially, right?
So you're paying closing costs to, let's say, save money, but there's not enough time from the actual refinance to recoup your costs because you're selling the property. So there's usually what's called a break-even point. Let's say, for very simple numbers, let's say the closing costs are 10 grand, all right? And you're saving $1,000 a month, right? In 10 payments, you're going to recoup the cost of your 10 grand.
Yep.
If you plan on selling the house in 5 payments, you're a net negative. Does that make sense?
Okay. Interesting.
So you have to weigh, there's always a cost associated with the refinance, and you have to weigh the pros with the cons. Rule of thumb is, if you plan on selling the property, you shouldn't refinance because you're incurring costs for no reason. Make sense? If you're planning on selling the property in the near future.
Okay, great. So I'll flip that. How early can one refinance?
It depends on if they bought it cash. There's a few different guidelines.
Is that the LTV? Are we going back to the loan to value? Is that where you're going with this, or?
No. Where I'm going with this, if you buy a property cash, that doesn't you can't really refinance it the next day for, let's say, more than you bought it for. Let's say you buy it for $300, but it's worth $500.
Mm-hmm.
You can't refinance the next day and pull out $500 because the bank's, you're kind of tricking the bank, right?
Yeah. So I guess that's so interesting because
there's a certain time period.
Yeah. There's seasoning. Okay, cool. That's awesome.
And I would have to, there's a chart that I would have to look at. Don't quote me on those numbers, but
you got a chart with your brand on it? We'll make sure.
No. It's the actual government handbook. We call it the Matrix.
Gotta give us a pictographic, man. Drop that in the story, man. We'll all go follow, man. That's interesting.
Speaking of LTV, there are certain LTV restrictions for certain products. If you're doing a regular rate and term refinance, meaning you're just trying to lower your rate or cut the amount of years left on your mortgage, traditionally there isn't an LTV restriction. But if you're pulling cash out, there are LTV restrictions because banks want you to have
Skin
and
in the
remain
game.
they want skin in the game, correct.
Yeah.
And the higher that you go on the LTV or the percentage of financing on a cash out refinance, the higher the interest rates go, because it's more and more risky the more and more you pull out.
That's right.
And that's really how banks look at everything, is risk.
That's right.
Which we can go into too if you'd like. But every interest rate is based on risk. So if I'm putting a larger down payment, I get a lower rate because I have more skin in the game. If I have a higher credit score, there's lower risk, so I get a better rate. It's all tied into the likelihood of you paying the loan. And if that likelihood is high and there's lower risk for the bank, you get better pricing. That's
I think
essentially how pricing works.
that's a great segue, because one of the things that you touched on that I want to make sure didn't slip through the cracks was mortgage insurance. And
Yes.
I want to take a step back as to what you just said, because essentially what you're alluding to here is the fact that you have to always factor in the numbers, right? You know, and I think what is fascinating is what must be fascinating for you is being able to show your clients and your partners that, you know, okay, this is how much this is going to cost you, right? Like, I think people need to know more of that, like opportunity cost and like the longevity of the cost versus, you know, if you're putting more down versus not. And I want you to touch on that a little bit, because you're the expert. That's why you're in the lab. Tell us a little bit about, you know, mortgage insurance and how much of a factor you see people either do take it into consideration or not, as far as, you know, going into an investment.
Yeah. So for the people who don't know what mortgage insurance is, it's essentially an insurance that the banks require to protect them, not you. So there is no benefit to having mortgage insurance. It's very common to mix that up with homeowners insurance, which is to the client's or consumer's benefit. That
great clarification. Thank you.
That protects that homeowners insurance or hazard insurance is, all right, a tree fell on my roof, I can make a claim, much like car insurance. Mortgage insurance is to protect the bank. So it is an additional monthly cost and sometimes an upfront cost. There's a bunch of different ways mortgage insurance is calculated, but I really like to boil it down to, again, those two main programs. There's FHA. That mortgage insurance is called MIP. It's not PMI. So MIP, mortgage insurance premium. It is FHA loans are a government loan. So where does the mortgage insurance come from? The government, right? FHA mortgage insurance doesn't matter your credit score. It matters very slightly how much you put down, only in increments of significant increments. And for the most part, especially if you're putting minimum down, it's for the life of the loan. That mortgage insurance does not fall off. It's a percentage of the loan amount, so it's 0.85% annualized. So you have a calculator in front of you?
I do.
I don't want to. Okay.
Want me to work?
I don't want to.
Let's do it right here. Talk to me, brother.
Go away from my phone. So let's say it's a $300,000 loan amount, or let's say $300,000 purchase price. Okay, I'm a regular consumer. I want to put 3.5% down. So it's a $300,000 purchase price, which means it's a 96.5% financing. You follow me so far?
I'm following you.
300,000 times 96.5. What does that come out to? 96.5%.
It's 289,500.
So that is my true loan amount, right? After my down payment, that's what I'm financing.
That's right.
What FHA says, not only do you have to do monthly mortgage insurance, but there's also upfront mortgage insurance. Now FHA upfront mortgage insurance premium is I think 1.75%. Again, don't quote me on that. So if you times that by, what is that loan amount again?
289,500.
289,500 times 1.75%.
That's 1.75. You said
Yep.
0.175.
Yep.
That's 50,000.
No.
What did I
Sorry.
put?
It's so do that loan amount again. It's 288
Yep.
500
289 500. Yeah.
times 1.75%.
506.
It could be like 5,000.
Yeah, I'm sorry. Oh, you know what I'm doing? Gosh, this is my decimals, guys. How embarrassing in the lab here. Not even using my calculator. 0.0175. Is that what we're saying?
Yes.
There you go. 5,066.
Okay. So FHA, not only are they going to charge you monthly mortgage insurance, they're going to charge you upfront mortgage insurance. Good thing is they allow you to finance it in your loan amount. So they roll it in on top of that 288,500. So now add 288,500. 288,500, that is.
Got 293,566.
That's your FHA loan amount, okay, after the mortgage insurance premium is added in. So there's that upfront mortgage insurance as well. Now let's calculate the monthly. How does FHA do that? They times that by 0.85%.
Okay.
So do that.
5%. So times. So that's 0.85%. So that's 0.085, right? Boom. 24,953. Is that right?
No. So it's 0.85%. You might need to add another zero.
2,000.
Yeah. Okay.
2,495. Yeah.
Divide that by 12.
207.
Gotcha. So that is the monthly mortgage insurance. So they hit you
Eric's
twice.
Eric's taking me back to my math 101 where I'm like not putting in my tenths and hundredths, but that just shows you, right? It's so funny because I'm looking at financial all the time and I can't use a calculator.
No, and I still do the same thing. So basically FHA says, all right, you're putting 3.5% down.
Yeah.
We're gonna add 1.75% to your loan amount. That's the upfront premium. Then you're also going to have monthly mortgage insurance for the life of your loan. That's FHA.
Yeah, and
right.
I want to bring that home because you mentioned that's a lifetime. So that you got to factor that in, and it ties back to our other conversation where I'm going to ask you the question because you're the expert. Can I refinance out of my FHA loan
if you have enough equity?
So that's the caveat, right?
Yeah, I'm going to get to that right now. So first, what actually happens with that FHA mortgage insurance, the upfront and the monthly, it actually is deposited in like a pool for the government so that anytime an FHA loan defaults around the country, they can bail that out, right? It's an insurance to protect the banks against foreclosures.
Insurance policy, yep.
So essentially you're paying for other people's foreclosures. That's what mortgages are. That's what mortgage insurance is. So that's FHA. All right. So let's get FHA off the table. Notice how the main things, there's upfront and monthly. There is, it's for the life of the loan. And for the most part, it's a flat rate. Okay. Now, conventional mortgage insurance. This is called PMI. And that's because it stands for private mortgage insurance, and it is exactly what it sounds. It's a third-party private company that provides this mortgage insurance, unlike FHA, which is government. And because it's third-party and it's private, and the nature of how it's calculated is they look at you and give you a custom quote. All right. And now it's mainly driven by two things. There's a bunch of different things that are factor into the pricing, but mainly driven by two things. Number one, your credit score. Number two, your down payment. All right. You get significantly better, the better your credit score is, and the larger your down payment. Another thing to mention with conventional. So for instance, same person, same purchase price, same loan amount that we talked about. Remember, it was 0.85% monthly. If I had a 760 score and I was putting 5% down, it would probably be around 0.2%, which monthly mortgage insurance at that rate would be maybe $80, $100 versus the FHA mortgage insurance. It matters more the larger the loan amount, though. If you're borrowing 500, those percentages and those differences are bigger amounts.
Yeah.
So that's one benefit of conventional PMI, that it's cheaper for people with better credit scores. Second is there's no upfront, right? There's no upfront, just monthly. So your loan amount is actually lower. There isn't that additional cost. Third thing is it's not for the life of the loan. It can automatically terminate at 78 LTV. And you can request it to be removed at 80% LTV.
So that's loan to value for which we did
Correct.
bring up earlier into the episode.
Correct.
That's
So
very interesting.
basically when you have enough equity, all right? So after you pay your mortgage for a few years, you can request it, or when your property values go up, you can request it, or you wait a little bit longer and it will automatically fall off. Now, the reason I go over all of that is because a lot of the times, unfortunately, first-time home buyers, their situation maybe calls for a conventional loan versus an FHA loan, and they can avoid the refinance, right? When you do an FHA loan, again, it's for the life of the loan until you have enough equity to refinance out of FHA and into a conventional loan. That's the whole point of that 20% threshold. So if I can skip that, right? And let's say I get my credit score to, above 700 where PMI is cheaper and I don't have upfront, and it eventually falls off, there's no need to refinance and incur the cost of refinancing. However, this isn't to demonize FHA loans, because FHA loans serve a purpose, right?
For sure.
When you talk, especially for the house hack community, for the people who are house hacking, I help actually a lot of first-time home buyers house hack.
Nice.
And the reason I bring that up is because multifamilies are very common for house hacking. There are certain restrictions for down payment on conventional loans for multifamily. So a lot of the times the best route, or the only route, when you buy a 2-family house is 3.5% down with FHA. That's why Bigger Pockets and a lot of these famous house hackers always talk about FHA loans, because 3.5% down is the minimum that you can do for a 2-family house. Conventional, unless you fit into a small box, which I'll talk about in a second, conventional, the minimum down payment for a 2-family house is 15%, even if it's a primary. That's why FHA serves its purpose. And also, you can go higher on debt to income ratios. So if that's you, it fits you better. Now, there is an option with conventional, and not to bore you guys with guidelines and programs and stuff like that, but I'd have to finish off.
This is the juice that we came for, Eric.
I'd have to finish off with this. So there's something called, there's 2 conventional entities, Fannie Mae and Freddie Mac.
Freddie Mac, yep.
Okay. You may have heard of Sony Mae, and if you have heard of them, I'm sorry. That's for student loans, but there's Fannie Mae and Freddie Mac, right? Freddie Mac came out with a product called Home Possible, and it's designed for first-time home buyers, and it allows you to buy a 2-family house using a conventional loan with 5% down. So the mortgage insurance for certain individuals may be cheaper, and you only need an additional 1.5% on the down payment versus the FHA 3.5.
3.5.
Right. So you kind of skipped the need for the refinance. That's the main thing that I'm trying to drive home here. Now, in order to do a Home Possible loan, that 5% 2-family program, you need to fall within income limits, which it's based on the zip code. It's basically based on opportunity. So for opportunity zones.
Opportunity zones, yeah.
It's basically to give people more opportunity, right? So it's based on the zip code that house is particularly in. Mm-hmm. And here in Long Island, the average income limit is probably $70K. A lot of the times, unfortunately, in order to qualify for a house, you need to make above that. A
Yeah.
2-family house in Long Island I'm talking about. So most of the time, again, when we talk about a multifamily home with a low down payment, FHA is the best route. And then the goal is down the line, once you do pay down that mortgage or the value goes up, is to refinance into a conventional loan without mortgage insurance, and you're set to go.
Wow.
That a lot of information.
Apologize. This is what we need, and this is what you're gonna get. I really appreciate you covering that because I think a lot of us, and I'm glad you talked about that 15% down as well, and the leverage of FHA and knowing when to use what. And I think that's the entire goal with this, having the knowledge to know, knowing what to do, and then at the same time, what things you need to focus on. The one example particularly that sticks out to me is the one where I might be on the bridge between FHA and conventional, and I might just really need to just look at my finances and make that decision to then put myself in a good position for the long run to either not have to think about getting rid of or I guess if it's FHA, it's MIP, or you can't get rid of, have to refinance, or on the conventional side. Oh, I got you, brother. I'm here. This is really good for our listeners and who may or may not be familiar, because I think these things you gotta be familiar with them, and you gotta make sure this knowledge is top of the mind. But or for the conventional, removing the PMI. But I'm sorry, did you want to add something to that?
Well, I would just say that I think it's so important to have somebody explain all of this to you.
Yes.
Unfortunately.
And which, by the way, you're doing a fascinating job. I have to say, you're really good at explaining. Yeah. And
because I do this, I have that same exact conversation probably 15 times a day. So it's just repetition. I'm nobody special, but unfortunately, what I see is a lot of first-time home buyers, especially, go through the whole entire process and not learn anything, and not know any different, and maybe get stuck into a product that they may have had better options, or if they moved money around again to better themselves long term. And at the end of the day, it's very important to have somebody that's going to explain this to you and knows the ins and outs of it. Because although there are advantages and disadvantages to every program, sometimes your situation calls for a certain program.
Case by case.
And that, like I said, that's not to demonize FHA loans, because that, for instance, that low down payment multifamily route, a lot of the times FHA is your only option. Another example would be you need a large seller's concession. FHA loans, you can do a 6% seller's concession. Conventional loans, they cap you at 3%. So in that scenario where I'm super tight on cash and I don't have enough money for closing costs, an FHA loan will allow me to get a double the size seller's concession. And that means FHA is a better program for me. That's just one example out of many.
Can you touch on that seller's concession?
Yeah.
I might not be familiar with that.
Oh yeah, so my fault.
No, you're the expert, man. We gotta extract.
A seller's concession is when your seller, you can no longer technically finance closing costs. Okay, so the financing closing costs would mean, all right, 105% financing, like no down payment, no closing cost. Like that's how it used to be, right? Now what you can do is ask the seller to contribute to your closing costs.
Closing cost contribution, right?
Correct. So yes, and you'll see this in contracts, you'll see this in offer sheets, and you'll hear it kind of talked about. Again, never explained though. Now, usually, sellers don't give you money out of the kindness of their heart.
Right.
So, usually, how a seller's concession. Sometimes it's simply you're buying a house for $300. I'm getting a $10K seller's concession. The seller's walking away with $290. Make sense? That's the sometimes. Most of the time, it's I'm buying a house for $300, but I'm gonna go into contract for the house at $310 or $320, and that extra 10 to 20 grand is gonna go towards my closing costs, because the seller's gonna get the extra money, but they're gonna give it right back to me.
That's right. Yeah,
So they still net $300K. That's the important thing to mention. So that now the one variable is the house needs to appraise for that inflated contract price. If the house doesn't appraise for 310 or 320, then you have issues.
That's right.
You're not going to be able, the seller isn't going to be able to get that extra money from the bank to give to you for your closing costs. That's seller's concession.
That's a really good strategy that I've actually used with folks that have helped my buyers in I guess in a seller's market. Sometimes you have to do that to get the deal, and if there's enough, like you said, if it does appraise and there's enough icing on the cake, then there you go. You can, and it's so interesting because I think now, just not to get too sidetracked, but it's a nice psychological trick too for the sellers. If they're going to get their number that they're looking for, and then they're going to come out of them anyways. And at the end of the day, it's a really good tactic that we should use as investors. Okay, cool. That's fantastic. So you've done a fantastic job of literally just breaking down your knowledge, your expertise, and which is really fascinating to see, because not only are you really passionate about it, but you know what you're talking about, which is great, and you know how to explain it very well. I want to get into the kind of the person behind that. I call these the rapid fire questions, man, and then we'll finish up with what you do very best, is how you deliver your message out. But talk to me. You must educate yourself. You're a good teacher. It means you're a good student. What are maybe what is a favorite book out there that really I guess brings out the arrogant out of you?
It would have to be, I was going to say Think and Grow Rich, but I'm going to flip it to the Bible.
Nice.
That's and my favorite book in the Bible is James. So that scripture changed my life, and I mean, business, personal development, spiritual, the Bible has everything. So
man, good for you. That's really refreshing.
That is the book, but other than that, I'd say Think and Grow Rich, but that's a generic answer.
I have me on the Bible on here, man. That's really deep. That's awesome. Yeah. That's really good. Cool. So what do you think is the best habit that serves you every day?
This is something I honestly speaking, I need to work on daily habits and daily regimens. That's something that I fall short on.
Yeah.
I will tell you this, the thing that I do every day that I'm consistent with is work. Sometimes there is no organization. Sometimes I don't have the best time management, but I try and complete the tasks that I set out. So the one thing I probably do really good is make lists and try and accomplish those lists before the day is over.
Nice.
But that's very, very simple.
And that's what works, man. There's no hacks out here. I think people are always looking for a lot of hacks, and I think what's really refreshing is you coming on here and getting down to the basics. And that's why I like having a lot of practitioners who really get down to the basics and give you something practical to do. So good for you, Eric. Excellent. So is there a tool that you think that helps you excel throughout the day? It could be an application. It could be, like you said, a notepad. What helps you get through the day?
It would definitely be my CRM. My CRM helps me.
What are you using?
I'm using Salesforce.
Nice.
Like a mortgage specific built out Salesforce. But yeah.
Yeah, shout out to Salesforce, man. It's they've been in business for a minute. That's awesome. Cool. If you had a superpower, what would you pick, Eric? That you could use in business day to day. What would that superpower be? Maybe something you want to work on.
Business?
Business and life in business. Let's talk business, because we got you out here. You're the subject matter expert. What is one superpower that you wish you could have in your business?
The teleport.
What are you trying to get away from? Remember, the people are coming to you, man. Where are you trying to get away? Where are you trying to go?
I'm trying to pop up and pick up their tax returns, so I don't have to wait.
Oh my gosh, that's so funny. Chasing them.
That's the business. That's the business use of the teleportation, and then personal use, I can just be out when I want to.
That's awesome. If you could describe one successful investor in one word, which word would you pick?
What was the question?
If you could describe a successful investor, or in your case, a successful lender, let's say, what would be the word that you would pick to describe them, or describe what you do? One word, in one word.
One word is tough. I'd say either efficient or transparent or good with communication. I can't think of a one word for that part.
That's a good sec. That's
Yeah.
good. Okay, transparent, efficient. Is that what you said?
Yeah.
Efficient. Yeah, that sounds like right on. I'm not surprised by those answers. You talk about communication. I want to transition right before you exit the lab. You're doing a very good job of really producing great content and communicating with your community. Do you want to talk a little bit about why that's so important to you and why you feel it's important today in this day and age to really, be out there like the way you're doing it, man?
If I want to impact the most people, I have to be where most people are. Okay. And that's social media. So I'm going to say 80% of the time that we spend on the internet is usually on Instagram or Facebook. It is became the internet. So if you're in the business of impact, if you're in the business of connecting with people, and if you're in the business of networking, you need to use these platforms because you're never going to be able to meet as many people as you will be able to meet other than through these things. And that's exactly how we met. So this is just one example of the many, many, many people I've met. And I'm talking about impressive individuals. I'm not talking about just fair weather friends here.
Yeah.
So that's really what I try and strive to do, is use social media to take those online relationships offline and add value to them in any way.
I love that, and you're doing a phenomenal job, and I want to piggyback that, and yeah, give you kudos, man, because you're crushing it on there, and I know it's I think it's really good to point out that I think you can fake it, but I think it's hard to fake being a true practitioner, and people sense that, and you're going to attract the right people. That's why I was like, I got to hit you up, man, because you're keeping it real and you're doing it right. And I think the other point I want to bring home is you touched on this on your social media, because it's a good avenue. You guys should definitely check it out. Is to, I think people are using technology to, some of them are using the right way, like you are, and then some of them are kind of using it as a way to separate themselves from the people, when really technology is allowing us to connect with more people. So I always say, what a time to be alive, man. Like it's really unbelievable to be able to connect with you, miles away, people from different coasts, countries, and being able to add value. And I think that's something I definitely want to piggyback, and yeah, man, you're crushing it. So keep it up, and guess where I got a new avenue of sending business your way, just like that. So for sure, we'll make sure that the people, if they have any more questions, I know you're very engaged with the community. Where can people find more about what you do and what you can do for them if they're looking to get into a home or simply want to ask some questions and have a family member they want to send your way?
Yeah. I mean, I'd say Instagram. My Instagram handle is Not Your Average Lender, and hopefully after listening to this, you found out why they call it that.
You heard it here first.
And then also, you could always just shoot me a text. It's 516-265-4244.
My man. And just like that, Eric Braun, y'all, came in, dropped knowledge, dropped some value, and you guys make sure you check him out. And just like that, we are out.